Hey guys, welcome back to the channel. Today we're going to be talking about common mistakes that people make, right? There's a few, right? Common IRA mistakes. I think I've got 5 for this video today. I'm sure there's more, but I want to talk about the ones that I think are the most common, right? So, for some investors, IRAs may be long-term hands-off investment vehicles. But that does not mean you should ignore them completely, right? Like let's say this year, right? If you give a little love to your IRA and make sure you're not making these, common mistakes, you might end up in a better place than you think. Think about last year, right? The market, went down so much that if you did a little bit, some of these things we're gonna go over. If you didn't make these mistakes, you probably saw tremendous returns, right? So the first thing we're going to talk about is not taking enough risk, right? Right? Often, we talk about risk being a bad thing, but it isn't always, right? Like it's not always a bad thing. A young investor who isn't planning to touch their IRA for 20 or 30 years should have enough time to weather, you know, market swings, like whenever they occur, right? Meaning that they could take on more risk in exchange for potentially higher long-term returns, right? Advisors say like such a portfolio could compromise mostly stocks or even all stocks instead of splitting the allocation between stocks and bonds. When it comes to investing, the most powerful commodity is time, right? You can never get back time. However, time is only useful if you know what to do with it. So simply put, too conservative of a portfolio could potentially limit returns down the road, making it more difficult to hit your retirement goals. However, it's also equally important to rebalance your portfolio away from those riskier assets the closer and closer you get to retirement. I forget who it is specifically, but someone had said base it off your age, right? Whatever your age is should be about how much you have in bonds, and the opposite should be, I think it's based on like the value of like 100, right? So like me, I'm 32, so 32% of my portfolio should be in bonds, and 68% should be in stocks. And you might visit this every 5 years or however you want to do it. There's multiple ways you can do it, or maybe you want to take your age and cut it in half to be like super aggressive, like whatever you want to do, right? It just depends how aggressive you want to be, how comfortable you feel with taking risk, but you definitely should be taking risk. Next thing we're going to talk about, failing to fully fund your IRA every year. This is one of the big ones that I know a lot of people don't do, right? Like I get it, right? Long-term IRA investing isn't super exciting as trading and in a broker's account, right? Day trading, just you can buy those penny stocks, right? You bought Doge at 10 cents and you saw it go up to 90 cents, and now you've heard about the Dogecoin millionaire, right? I mean, those things are exciting. You want to do that, but it's super rare, right? But if you're investing more in a taxable account without first maxing out your tax advantage IRA, I know a lot of tax advisors and financial advisors and stuff like that. They want to tell you a couple things because you're messing up, right? Because by not fully funding your IRA first, which let's say in 2021, I think it's $6,000, right? $6,000 a year, right? So by not putting in that $6,000 this year, right, you're foregoing huge tax advantages and potential opportunity for that money to compound tax free, right? Too often people fail to realize that huge advantages of a tax deferred account, instead investing in a taxable account. These advantages are greatest for those with the longest time horizon to retirement, right? And on the point of taxes, right, it's also important to know the difference between traditional and Roth IRAs, right? So, in short, basically, a traditional IRA, the contributions are tax deductible, while withdrawals are taxable. Roth IRA contributions are not tax deductible, but withdrawals in retirement are tax free, right? So the next thing we're going to talk about, dollar cost averaging. I talked about this in the last video, and we're talking about it again because it's just that important, right? Contributing slowly instead of all at once, right? In most cases, making regular contributions to your investment, right, known as dollar cost averaging, is some of the best advice, right? However, if you've got the cash, maxing out your IRA as early in the year as possible could be the way to go, right? Anytime a large amount of cash is involved, investing it incrementally over time may feel like the responsible thing to do. However, those positive feelings are generally the only benefit. Dollar cost averaging equates to taking risk later, right? You might mitigate short term regret, you're more likely reducing long term returns. A better exercise may be evaluating your asset allocation target relative to your risk tolerance. In other words, dollar cost averaging could help you avoid the stress that comes from stock market volatility, but a lot of times it could lead to longer term returns than lump sum investing. And if you're still uneasy about investing all 6,000 up front, which I know most people can't do it, right? But like if it's the beginning of the year and you can fully fund that and you can dollar cost average into a different IRA account, that's what I would say do. But consider a less risky allocation if you can't do that, right? Such as investing more in bonds, right, instead of spreading out your contributions, right? The next thing I want to talk about, right? Failing to explore your investment options. You should always explore your options, right? So if you started an IRA by rolling over a workplace 401k, you probably noticed you are no longer confined to the investments offered through your 401k. Right? And that's kind of a big deal, and the influx of options you should really go through them, right? Like don't just cash to the side and be like, I'm going to leave it to the same, right? An advantage of an IRA is the flexibility you have of what to invest in. You can really dial in on specific investment strategies that's tailored to you. And most people don't take advantage of this, right? So, you can look at it and be like, the companies your 401k rolled over into your IRA, you could go through it and be like, I don't like this, I don't like this, these are bad, this is bad. Like, you could do your own research into it and sell off certain ones, and then you take those certain ones and you're like, okay, I'm going to sell those, and then I'm going to put that money into these other stocks that I do like, right? The last thing that we're going to end up talking about is maintaining multiple retirement accounts, right? There's no rule that says you can have only one IRA. As long as your annual contributions don't exceed the limit, you're free to disperse those contributions across any traditional or Roth IRAs you've opened. But that's probably not a wise strategy, right? Keeping multiple IRA accounts rather than consolidating into one very often leads to overlap. It also takes away from the positive effect of rebalancing, which can reduce your overall risk. This goes for hanging on to old 401ks instead of rolling them over into an IRA, right? Not only will you avoid overlap and find more investment options with IRAs, but it's also possible you'll pay less in fees, right? So, you have a limit to the amount of money you can invest in a year, right? And if you're putting, say it's $6,000, you're putting $2,000 in this one, $2,000 in that one, and $2,000 in that one, and let's say you get a 10% return on each one, okay, well, you've made $200 in each one, and it's like, $600, but what if you put $2,000 in each one, and one of them made 20%, another one made 5%, and another one lost 5%? Well, what if all of those were actually in the one that made the 20% return? Then you just made a bunch more money, right? And, like I said, there's a lot of fees that go with it, and you really don't want to be worrying about all the fees you may or may not have to deal with, right? So, hopefully you guys got some good information from this, and there's some things that you liked or didn't like, and you can tell me what they are down in the comments section, right? Go ahead and give this video a like and a subscribe. Hope you guys enjoyed the video, and until the next one, y'all be safe.